Is the 2020 crash worse than 2000 and 2008? Not yet, but I gotta tell you, there are some really ugly signs. We're gonna look at the charts. We're gonna look at the data. We're gonna get you prepared. So sit back, grab a cup of coffee, and let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links from today's video. Also, if you're looking for a different opinion and you're here for a reason, I know you are, different opinion out of Wall Street and Big TV, please do consider subscribing. So today, we're going to talk about the 2020 crash. And yes, it is in fact a crash. Let's not get caught up in last week's bear trap. Going to talk about that when I get to the big charts, the technicals. What are they telling me? From there, we're going to go to what keeps me up at night. Now, believe it or not a lot. Why? Because I have a process, a clearly defined process that allows me to make non-emotional decisions. From there, we're going to game plan, give you a blueprint, and that's it. So let's go to the big charts. All right, let's start with the big charts. Monthly view, long term, okay? What we see here, this is the 09 bottom, and you can see that's a trend line, and we've broken that trend line. That is not a good thing. Very much negative right now. The other confirmation is here. You see other times when momentum goes over, okay? Black goes over red, no good. This is over big time, much more so than it was in 18. So yes, we are negative long term. Midterm, same thing, negative. Obviously, you see all the breaks here. Look at momentum down here. Sorry about that. Look at momentum down here. Big time crossover. We are negative there as well. Now I'm going to show two looks at the daily chart. Why? Because I'm going to tell a story here and hopefully you'll understand. Last week, all over Twitter, Facebook, I kept on saying, be careful. This is a bear trap. You had month end. You had quarter end. This is when we get rebalancing for pensions, 401ks, etc. So we were going up with less volume, not a bullish sign at all. Now, when you look here, this is these lines, the Fibonacci retracement. Have a link here, did a video on that, but Fibonacci was a mathematician. You take your most recent high, your most recent low, and you create resistance support. And you can see this line right here, classic, 38.2. That is your resistance, and we failed here. We came up, then we failed, right? And you kind of see what happened. And each time we tried to get above it, it stopped. It exhausted itself. The market exhausted. Yesterday, obviously, we got even closer. It failed. And then today we have what's called a gap down as of 10 o'clock here on Wednesday. We're down about 3.25. So some of the things that I do over time, we might make trades last week, expecting them to play out within a few days. So right now, when I look at the short term, that is negative as well. So the other thing I want to bring up here is we have your 200-day moving average in blue. Your red is your 20-day moving average, and then your 50-day is in green. So what happens is when the 50-day crosses over the 200-day, that's called a death cross. As you can imagine, that's not a bullish thing. If it goes above, that's a golden cross, okay? We have had a definitive death cross with the 20 and 50. There's been a lot of studies done about percentages and risk and when to get in and get out. That is a clear sign to get out of the market, so we are negative. All right, now, a big part of our process is volatility, so price volume volatility. When you look at it. So volatility today, we're at 55. Above 30 is uninvestable, folks. I've been saying this, okay? You've got options volatility still down a little bit today. Oil volatility was 170 yesterday, but down to 149. People say it's a time to buy oil. Absolutely not. Not with the volatility index that high. Now, there's two areas that I'm looking at, gold and 10-year, and you can see they've come down pretty nicely. So I saw some opportunity last week, and let's talk about that. So right now, there's not a lot of longs, things that I own, okay? I have as many shorts as longs right now, and I'm some different areas. But we're looking for opportunity. You look at gold, we were in gold back in 18, okay? Hit a peak there and really got hit pretty bad a couple weeks ago. That was when we had a liquidity crunch, a margin call. People were trying to sell assets, okay, to take care of those margin calls. So it came down. We started tiptoeing back in, have a small position right now, taking a hit today, but I think long term, I do like it. So if it comes back in the low end of my range, I might then add and go to a full position, which is about 5%. The other thing we've talked about volatility, you can see we're under 30, and I like that as well. Next, long, dollar, US dollar. In this cycle 4, dollar will generally do well. Now, we did see this pullback. It was an opportunity for me to finally move in. All right, now a couple things with dollar. Yesterday, the Fed created a credit facility for the Eurozone, okay, where they can go in and swap treasuries for dollars. There's a dollar shortage going on right now, so this should hopefully help us with that trade. The next thing is treasury. Same thing. We got an early here in 18. Talk about that in a second. And when you look here, same thing with gold, right? Took a hit, went up. We actually got out of it because of this liquidity issue. We also had a big issue with bid and ask. Buyers, sellers, big time spreads. Not a good place to be. But again, we started tiptoeing back into that late last week, and we're moving down again, probably at the low end of our range on Treasury. So going to continue to watch this and hopefully move ourselves back up. At one point, I was 20% in Treasuries. Now I'm less than 5%. So from here, let's talk about what keeps me up at night. As I mentioned, you know, the process. It's all about the process, something we've been working on for 6 years. And I'm able to sleep because, quite frankly, our process makes our decision. These aren't emotional decisions. What drives me crazy, though, are these folks on big TV, right? We're not talking about a financial system cratering. If there is to be a recession, a lot of the stock market damage has been done. Now, Car Quintanilla, but that actually came from Josh Brown. Let me be clear. We are in a global recession. Every single country is in cycle 4 right now, okay? And here's our boy Jimmy Cramer. All the way down, buy, one of my most trusted buy signals. How can you not start buying here, right? This is what these people do. They are trying to keep their advertisers happy. Forget about that. My job is to manage risk. Now, Janet Yellen, don't see a financial crisis occurring in her lifetime. Hello, Janet. That one didn't age well. Now, yesterday, Janet Yellen says too much corporate borrowing will hinder economic recovery. Duh! Who started this mess? Her and Bernanke. They are the architects. He started at Bernanke. She continued it on. Free cash. It is just the worst thing that's ever happened, and we're going to talk about that right here. Here's your federal debt. Pretty reasonable. Then we had the crisis of '08. Okay? QE, QE1, Operation Twist, and all that. All right? Now, we've had this big surge up recently, and I'll get into that in a second. But we started going down, and what happened was they created all this free money. For who? For Wall Street, for big companies, for hedge funds. What did they do? Did they build into infrastructure? They bought their stock. Of course, if they're borrowing at next to zero, okay, they bought their stock. That has really pushed the markets up. And then they created credit for any of their infrastructure needs. Now, we went from $2 trillion to $7.5 trillion in credit. This is the biggest issue right now that scares me. Okay? If you want to know why I'm bearish, this is one of the biggest issues. Why? The high yield market is starting to crack. That is not a good sign. All right? From there, I mean, now the Fed's trying to stay ahead of it, but already Moody's has downgraded 27 companies. This is such a big issue. Now, this shows daily what the Fed's been pumping in. Go back to 0809, okay? AIG received $85 billion. People went bananas, all right? How about last week? 80 billion, 95, 92, 90 billion a day, okay? This is what they're doing right now. So is this worse? You're darn right this is worse. This is an absolute disaster from a financial perspective. They are doing everything they can to keep this market afloat. And how are they doing it? With the same darn problem that got us here. Okay? That's my problem with the Fed. Now, we've talked about our cycles. We are definitively in cycle 4. Okay? Growth slowing, inflation. We were here before the crisis. Earnings were slowing before the crisis. And as I said, every country on my radar is now in cycle 4. Some of the things we look at, CPI. So we're seeing that deflation, PPI, same thing. You see that. Unemployment, to put things in perspective, right? 3.28 million people last week. Look at some of the previous crises. Tomorrow's our next number, folks. It's not going to be good. 3 retailers alone have furloughed, laid off upwards of 350,000 people. That's just 3 companies. This is an issue. Why? The consumer, we've been saying the consumer was slowing. It has now come to a screeching halt. The consumer, consumption, that's what keeps this market going. It's going to be a big problem. This shows how much small businesses can stay afloat, okay? For 1 month, 21%, 34%, 1 to 3 months. This is an issue, all right? Dealing with it with my family. My wife bought a company last year, consignment shop. She's doing some other things. Still going to pay rent. We've been shut for 3 weeks with 0 sales, okay? So again, earnings, we've talked about this. We were talking about this in Q3 18. We started changing our models at that time because of it. Adding treasuries, okay? Adding gold, bond proxies. It worked very well for us because as you can see, earnings were going down. Speaking of down, look at this ugliness. This is as of the other day, earnings in dollars, what different industries. That's oil and gas there, airlines, automotive, hotel, banks, etc. It is not going to be pretty, okay? So question, when will this end? Of course, nobody knows until we get a true remedy for the virus. I think that's number one, but we can only use the past as a guide. So what this shows is every recession, every pullback, the average recession is 20 months. Now, we've had some that were 3 and 4. We've had some that were 37 to 61. Okay? This shows some of the drawdowns, etc. So we don't know. We can only look at the past. And I can tell you, this is not like everything else, okay? These other ones. This is a recession. God willing, it won't go into a depression. What's your number? Okay, what do I mean by that? So just last week, we were down 30%. If you're in a 60-40 portfolio, which is moderate, you were down 18 to 22%. That hurts. When you're taking income as a retiree, if you're ready to retire, that's a big number. This shows you what you need to make to get back to even. And we go back to 08, 50%, of course, you need to make 100. But in that time frame, 60-40 was minus 38%. So you have to make 65 just to get back. So last night we're down 20% in the quarter, worst quarter in history. All right, so we've been able to reduce risk, right? Mitigate, reduce risk in our models, okay? Significantly being able to mitigate that risk in the 60 to 70% range. So we continue to manage risk. How far do we go for fair value? So red is where we are right now. That's 20. That's overvalue. That's exactly where we are right now. 15 is fair value, which would be 90 minus 39%, put us around 2,000. Here's the issue though, hasn't fully updated, so let me explain. They're projecting 110 earnings for the quarter. So if you take 110 times 15, that's 1650, okay? So that's PE, price earnings, right? So price times earnings get you a price. 1650 is fair value. Not saying we're going there, but you can see the kind of losses that are going to come about. Watch the volatility index. That's what I do every day, all day. I'm watching, looking for opportunities. But again, it's not a time to invest. When we have up days like last week, I took profits every single day on individual equities. That's what you do, okay, when you get a bear market bounce. Find opportunities, right? Not a lot of opportunities there on the long side. Gave you a few ideas, whether you hedge, short, cash. I have my largest cash position in history right now. That's a hedge, okay? Also, there's other things you could do, options and shorts and stuff like that. It's not easy. Not going to get into that. Something we do here, but a little more detailed as far as a compliance standpoint. Follow us for updates, okay? We are constantly putting information out there on Twitter and Facebook. We're here if you have any questions. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV. Be safe out there.